In the silver markets, a short squeeze occurs when the amount of physical metal available for delivery becomes constrained relative to the volume of futures contracts outstanding, forcing participants who are short to buy bullion at escalating prices to cover their positions. In 2024 and 2025, exchange data and independent market analysis show that the dynamics between paper futures markets and physical inventories have shifted in a way that reflects structural pressure on silver supplies rather than a temporary price fluctuation. A core indicator of this stress is the dramatic reduction of registered physical silver inventory in key vaults, especially on the New York Mercantile Exchange's COMEX futures platform, which is among the largest centralized venues for trading and delivering physical silver worldwide. According to recent exchange warehouse reporting and market aggregated data, registered COMEX silver stocks have declined by more than 70% from levels seen earlier in the decade, with periodic episodes in late 2025 where over 60% of deliverable inventory was claimed for physical delivery within a matter of days, exposing the thin nature of available metal relative to contract positions. The distinction between registered and eligible inventory is central to understanding this squeeze dynamic. Registered inventory refers to metal that is immediately available for delivery against futures contracts, while eligible metal is stored in approved warehouses but not immediately earmarked for delivery unless converted to registered status by owners. Recent reports indicate that only a fraction of total COMEX stockpiles are in the registered category at any given time, and even that limited pool can be rapidly depleted when delivery notices increase. Market analytics in late 2025 documented episodes in which physical silver withdrawal requests rose sharply, effectively diminishing registered stocks to decade lows relative to the scale of open interest in contracts, which continues to represent multiple ounces of paper claims for every 1 ounce of registered metal. This divergence between paper and physical markets has been developing alongside persistent supply deficits in the broader silver market. According to industry surveys, including those compiled by the Silver Institute and independent analysts, global silver production from mines has only marginally increased in recent years, while total demand from industrial sectors such as solar photovoltaics, electronics, and other manufacturing has outpaced mine output, resulting in a multi-year deficit. Persistent deficits have drawn down above-ground inventories that historically acted as buffers in periods of temporary imbalance. This macro supply-demand backdrop means that when institutional or industrial buyers seek physical delivery rather than financial settlement, the tangible metal available in centralized exchange vaults is insufficient relative to the scale of claims on paper contracts and long-standing structural demand. One of the hallmark signs of a developing short squeeze in silver markets is the behavior of lease rates and spot premiums, financial indicators reflecting the cost to borrow physical metal and the price difference between immediate delivery and future settlement. When lease rates spike and spot premiums rise relative to futures prices, it signals that participants are competing for limited supplies of physical metal. Market surveillance shows that lease rates historically low under normal conditions have on occasion risen sharply during stress periods, and spot premiums for physical bars and coins have widened as inventories in bullion dealer networks tightened. These market signals reflect genuine physical scarcity as much as they reflect speculative pressure. The consequences of a short squeeze extend beyond futures markets into the broader physical market infrastructure. COMEX itself operates on a delivery mechanism whereby holders of futures contracts can request physical delivery of silver. This is a standard provision of futures trading. When a significant share of contract holders elect to take delivery, either because of hedging requirements or changing preferences for allocated holdings, registered inventories are transferred out of the exchange warehouse system into private hands or into industrial channels, even when the unit count is unchanged. Once metal is removed from registered status, it no longer functions as an available cushion for future delivery obligations. In one documented episode, millions of ounces of registered inventory were effectively deregistered, meaning they were removed from the pool that underpins delivery obligations on the exchange, raising questions about the remaining capacity of the system to absorb additional delivery demand without resorting to alternative settlement mechanisms. A tightly constrained physical market increases the likelihood that participants who are short futures positions, those who have sold contracts without holding the underlying metal, will be forced to acquire bullion to satisfy delivery notices, thereby increasing upward price pressure. When a large proportion of open interest in futures far exceeds the available registered supply, even a modest rise in delivery requests can strain the warehouse system. One widely cited metric is the ratio of open interest or paper contracts to ounces of registered physical silver. At times, this ratio has suggested that only a small percentage of contract holders would need to elect delivery to effectively deplete the entire registered inventory. When this occurs, short covering, buying physical metal or futures contracts to close positions, can accelerate, amplifying price moves and tightening physical availability further. In parallel with these dynamics, the geographic distribution of silver inventories and policy decisions by major producers and holders also influence the availability of physical metal for delivery in specific markets. London's vaults, traditionally the deepest pool of wholesale silver, have likewise seen substantial drawdowns, with reported holdings falling significantly over recent years and with much of the remaining stock tied up in exchange-traded products or other non-immediately deliverable forms. When large volumes of metal shift between market centers, arbitrage mechanisms can operate to balance regional differences. However, when inventories are limited in one region relative to another, logistical and regulatory frictions can impede efficient physical flows. This can contribute to localized shortages that coexist with overall global inventories, complicating the delivery picture for participants who may be geographically concentrated in specific exchange venues. Another dimension in the evolving silver market is the role of institutional holders, such as major banks and exchange-traded funds, which can control large quantities of metal within the broader system. While these holdings contribute to the aggregate above-ground stock of silver, much of this metal is encumbered by investment mandates, fiduciary obligations, or long-term lease arrangements that do not translate into available inventory for short-term delivery in futures markets. The practical availability of metal for immediate settlement can therefore be much lower than headline inventory figures suggest, creating an additional layer of constraint when delivery pressure intensifies. The interplay between paper and physical markets also highlights more fundamental questions about market structure. Futures markets are designed to facilitate price discovery and risk transfer between participants with differing exposures. They are not intrinsically equal to physical demand and supply. When futures open interest becomes large relative to physical inventory, it can reflect the fact that many participants are using derivatives to express views or hedge exposures rather than to obtain the underlying commodity. A squeeze scenario tests the resilience of that structure by shifting the focus from financial settlement to physical delivery. Because the regulatory framework allows for cash settlement alternatives, and because exchanges can adjust delivery provisions under stress, the system can absorb some stress without catastrophic failure. Yet the relative scarcity of registered physical metal at times of acute demand highlights the difference between financial instruments and physical goods. What happens when industry demands physical metal that isn't there for delivery on the exchange? In practice, industrial buyers, refiners, and end users typically source metal through over-the-counter private channels or secondary market inventories rather than directly from exchange warehouses, especially when registered inventory is limited. Refiners and fabricators often hold their own stockpiles or have long-term supply agreements with producers to meet manufacturing needs. When exchange inventories fall, these private channels become more critical, and premiums in physical markets can rise as competition for available metal intensifies. In some cases, heightened demand for physical delivery in industrial supply chains can drive prices higher than those indicated by futures markets, a phenomenon known as backwardation, where near-term demand pushes spot prices above longer-dated contracts. Backwardation in silver markets is interpreted by analysts as a sign of immediate delivery demand outstripping supply that is expected in the future. When contract holders are willing to pay a premium for immediate settlement, it signals that supply is tight in the physical market relative to expectations. Historical data suggests that such episodes are rare and typically short-lived, but in a market with structural deficits and drawdowns of inventory, they can persist longer and exert more sustained price pressure. Elevated backwardation, combined with elevated lease rates and rising spot premiums for physical coins and bars, constitutes a constellation of indicators that market participants use to diagnose stress in the physical delivery system. In summary, when COMEX warehouses go empty of registered deliverable silver relative to the scale of outstanding futures contracts, the system faces a short squeeze dynamic in which the cost of acquiring physical metal increases, short participants become pressured to cover positions, and price discovery increasingly reflects physical scarcity rather than purely financial factors. Structural supply deficits, declining warehouse stocks, delivery mechanics, and the divergence between paper and physical markets all contribute to this scenario. While mechanisms such as cash settlement and off-exchange sourcing provide contingencies, the tension between financial claims and available metal underscores how physical availability can shape market outcomes when demand for tangible silver outstrips what is on hand for delivery.